You're now listening to the Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Presented by NiShacks.
Hi, everyone. You're listening to the Supply Chain Secrets Podcast. I'm your co-host, Caroline Weaver, and with me is Lars Jensen. Lars, how you doing?
I'm doing great. Calling in here early morning from Ottawa in Canada.
Is it cold up there right now?
I was out walking yesterday. Yes, definitely cold, given I spent a lot of time the last few weeks in more tropical areas.
Yeah, a lot of the episodes this year have been filmed in very warm tropical areas for you. So it must be a change. In Austin, it's been kind of cold here. It's been a nice change for me as well. Hopefully that sticks, but you never know with Austin weather. Let's go ahead and get started. So let's kick off with rates. Where are we at with the Pacific rates?
Yeah, the interesting thing with the Pacific is if we look at the quoted spot rates from the SCFI, there's not really much change. There's still a slow increase. What is much more interesting to note is this week's reading on the NiFi index on spot rates for loaded cargo. What we saw last week was we were beginning to see an uptick from Southeast Asia and Northeast Asia, but not from China. That kind of changed this week because now we saw a significant increase, around $600 per 40-footer from China into U.S. West Coast. So that does seem to imply that the uptick we saw in spot rates right after Golden Week is now beginning to be reflected, at least in some of the bookings made. Should be noted, though, that so far the quoted rates are up by $1,200 per FFE. Rate from NiFi measured here is up by $600. So we're not quite there at the same level yet, but there is certainly an uptick. But more curious, last week we also saw, as I mentioned, an uptick from Southeast and Northeast Asia. The Northeast Asia spot rates on booked cargo and loaded cargo this week actually declined. So we have this kind of weird pattern in spot rates coming out of Asia where there seems to be, let's call it, some vibrations going back and forth between the different origin. It seems this is likely also then down to the carriers. How do they allocate space on board their vessels between the different regions? So yes, there's an uptick now also in China rates, but I think the main keyword to put on the Pacific would be unsettled. And as I know we'll dig into a bit later here in the podcast today, we should expect it to be much more unsettled given the recent developments between China and US.
For our listeners that are maybe newer to the market, you were talking about rates and capacity sort of hand in hand. The carriers don't know necessarily where to allocate more of their capacity when the rates are fluctuating like this so much. Are carriers making decisions like this with small up and down ticks in rates, or is it more a matter of just this is how the market is trending?
I would rather put it the other way around. Carriers would tend to make tactical changes to their capacity allocation. Again, for those not quite familiar with it, figure a ship that, let's, for sake of argument, says this would be a weird rounding, but just to make the point, goes from, say, Singapore to Shanghai, then to Busan, and over to the US West Coast. The problem is that journey takes a long time. So I might have allocated, let's say, 5,000 TEU to each port, so I can fill a 15,000 TEU vessel, again, hypothetically. But what if the market in Singapore is strong? I might end up saying, fine, I'm going to book a little bit more, and then I reduce the allocation now for Shanghai and Busan. But my call in Busan, that might be, say, 10 days later. The market conditions might change during those 10 days. So when I finally make it up to Busan, there might be a boost in volume, but now I have a lot less capacity due to decisions I already made 10 days ago. You're making these tactical changes on the basis of the strength of the market as vessels are appearing to port, but this can change over time. And that creates some of these reverberations then. How does that then impact your spot rates and making the market unsettled? So it's not really the rate as such that is the source of the volatility. It's the fluctuations in demand. That's the source of this volatility. The carriers respond to that volatility by changing some of their allocation. But if the market then changes further on down the string that they're operating on, that creates the problem.
Yeah, and it sounds like the biggest variable is just time passing.
Yes.
And how that changes things. Okay. Thanks for walking through that. Where are we at with TA westbound rates?
The Atlantic is also an interesting one to begin to watch. I mean, spot rates there on the head haul, so that's from Europe over to the US, have been trending downwards for a while now. And if you're looking at the measurements, in this case from the WCI, what you will see is we are approaching almost historical levels. The reason I say almost is this is a time series where the WCI goes back to 2012, and in the second half of 2023, we still have very low levels on the transatlantic. Keep in mind, this is when most of the global markets crashed due to overcapacity. At that point, rates were still lower than where we are now. But if we look apart from the ending parts of 2023, rates we are now seeing on the Atlantic westbound are lower than anything we've seen in the last 13 years. So this implies a very low rate. And mind you, these are nominal rates. We're not even taking inflation effects into account. If we look at the NIFI, the NIFI is, again, a relatively new index. So we only have data going back a couple of years on that one. And here again, we are getting down to the same low levels that we saw in this catastrophic period at the end of 2023. So there's no doubt that right now, spot rates on the Atlantic are low, very low, and trending even lower. The reason why I think it's going to trend even lower is I was looking at data from Sea Intelligence here over the weekend in terms of capacity operated on the different trades. And when I look at the capacity change on the Atlantic, that is escalating dramatically in the coming months. Now, keep in mind the way they are measuring, they look at what are the carriers' announced services, what are the specific vessels that are sailing, which allows them to look out typically 12 weeks into the future based on what the carriers have planned. Of course, carriers could then choose to blank some sailings, but the problem here is if you look at a year-on-year basis, depending on which weeks or month you're looking at a 20 to 30% capacity increase in the Atlantic in the period ahead of us, which is very, very much extreme. Then there is a few caveats to that one. First of all, as I mentioned, carriers could choose to take some capacity out. Secondly, there's also another issue with this. When you start to dig into where's a lot of this capacity coming from, it appears that one of the major contributors to this is actually MSC. MSC is in the process of changing some of their services. Some of the typical east-west services are actually becoming round-the-world services, which means we're already beginning to see them phase into it, and that means we're now beginning to see 13, 14, 15,000 TEU vessels operating on the Atlantic. It's their Dragon and Albatross services, one coming from the Mediterranean over to the North American East Coast, another one from North Europe over to the North American East Coast. These are very large ships for an Atlantic trade. Caveat again here, these vessels are not only moving Atlantic cargo. I mean, they're coming all the way out from Asia. So they have Asia to Europe cargo, and some of that gets discharged. They would also have some Asia to US cargo, which still stays on board. So when we're seeing, for example, a 13,000 TEU ship leave from Europe to North America, it's not all 13,000 that's actually available. Some of it is still filled up with Asian cargo. The problem with these calculations is carriers never share how much allocation is dedicated to the different trades. We can only see that we're suddenly seeing the injection of very, very large ships into the Atlantic.
Well, it sounds like carriers might not even know what we were just talking about. Depending on where the market's at for each region, you might have more or less, coming from Asia, dropping off in Europe, or
at least it's difficult for the carrier.
Yes,
it's difficult to plan ahead of time. But the other thing this means is we are suddenly seeing now the advent of some exceedingly large vessels into the transatlantic service. And even if it's only a minor portion of that capacity, so the capacity is increased is not as extreme as it seems, it still brings in vessels with very, very low unit costs. I mean, if I'm operating a 13,000 TEU ship, my unit costs are clearly lower than a bunch of the other ships. Typically, ships in the Atlantic tend to be 4, 5, 6,000 TEU. So there is, even in the case where it's not a massive increase of capacity, if a lot of these slots are already filled, there would still be a downwards negative pressure on the whole freight rate environment in the Atlantic, putting other operators in the Atlantic under pressure. How are you going to compete with these much larger vessels? Are you going to, I was about to say, ignore them or at least just live with them? Or will this prompt the other carriers to also consider rejigging their service network somewhat and putting larger vessels into the Atlantic?
I guess there's a sweet spot though, right? Because a lot of the ports on the US East Coast are limited in terms of the size of the vessels that can go in there and drop off goods.
That used to be the case, but since the widening of the Panama Canal, a lot of the ports on the U.S. Eastern Seaboard has been upgrading their capacity to get used to the typical 15 ships that now go through Panama. So you see actually a lot of the ports and terminals in the U.S. Eastern Seaboard have upgraded capacity and do have the ability to receive these larger vessels. It would, of course, then put some pressure on some of the ports that still are unable to do that.
Yeah. Is there a cap where we're at with U.S. East Coast ports? Like what size vessels typically can't really go into those ports?
I'm not completely sure, but as far as I'm aware, it would seem that the ones that have upgraded can handle the 15 to 16,000 TEU vessels, because that was, again, in preparation for the flood of much larger vessels coming through the Panama Canal.
Yeah. Okay, that makes sense. All right, anything else to add on where we're at with rates?
Well, I think that covers pretty well at least the more important developments we've seen here over the last few days.
All right, then let's get into the latest on the China tariffs and trade. We had the meeting this past week. What's the outcome there?
Yeah, there's a bunch of different outcomes. I mean, we don't have full clarity. Let's be clear on this one. The most clear news we've got was actually a news flash that was uploaded to the White House homepage here over the weekend, trying to outline some of the details. My take on that one is, if you look at the concessions given by China, that means they're basically rolling back a lot of the retaliatory actions that they've taken during this year. So they're rolling back some of their export controls on rare earth minerals. They're rolling back their port fees and a bunch of other elements, all of which I see were introduced as retaliation in reaction to what the US did. So China is basically just rolling back their retaliatory action. If we look at what the US is going to do, one of the clear ones is the so-called fentanyl tariffs, the ones that were intended to penalize not just China, but actually also Canada and Mexico for not doing enough to stem the flow of fentanyl. Those fentanyl tariffs are reduced from 20 to 10%. Then there's an interesting one on the retaliatory tariffs that seems to be, at least as far as I can see, some sort of mismatch between what is now written on the White House News homepage and some of the verbiage that came out from the meeting last week, where last week it tended to appear that the reciprocal tariff would continue. The verbiage now on the White House homepage is that the reciprocal tariff will only retain the 10%. Right now, we should keep in mind that the entire world is still subject to 10% and not the higher reciprocal tariffs. So whether China is faced with the 34% or the 10%, I'm not quite sure, because there's some conflicting messaging out there. In that one, we should sit back and see, when does this come out as an executive order, or when does it come out in the Federal Register, so we know for absolute sure what is going to happen. But I'm a little bit confused in terms of what they actually mean here. We also see a bunch of other things that the US now is putting on pause. And mind you, this reciprocal one is just a pause. They're also putting the USTR fees on pause. And there's a bunch of other elements they're also putting on pause. All of this is on pause to November 10th, 2026.
It's pretty major.
It is pretty major, but, and there is a but, it's a deadline of only a year, which means that this whole trade war that we have seen very active between US and China here over the last 7 months, where I see this one is nothing has really been resolved. There's not a permanent agreement. We have wound the clock back probably half a year or so, but all of the underlying issues are then left unresolved. I don't want to turn the podcast into anything political, so I would rather put it this way. The trade war happened for a reason. The trade war happened because politically in the US administration, they had various issues with the way trade was working with China. We can then agree or disagree on what those issues are. Doesn't really matter. That's the position of the US government. They have an issue. Then they took a number of specific actions to address that issue. Again, we can agree or disagree between whether they were good or bad actions, but those were actions taken to address the issues. What we now see is all of those actions have basically been pulled back temporarily, but none of the issues are addressed. So that basically leaves us politically at the same point where we were early in the beginning, that the US administration seems to have a number of issues. Let's take the USTR fees, for example. The USTR fees came because it was identified by actually the Biden administration. That was when the study was undertaken, that there was unfair trading practices from China. Again, it's a political call. Do we agree? Do we not agree? But that was the conclusion, even under the previous administration. And the USTR fees was then the action to address the issue. So again, we are at the point where the issues are still the same. The issues are unresolved, but the actions have been pulled back. That does not create for a stable environment looking ahead, because at some point, these issues are likely going to have to be confronted again. I don't see any movement towards solving any of these issues where we are now. If we are lucky, then everything is on pause for 12 months, and there might be a more lasting agreement coming up in those 12 months. That might happen. It could also be that relations sour before the 12 months are even up, and we see a lot of these actions rolled back in. That, again, would be within the realm of the possible if we see what has transpired. So I see this as a temporary pause. What we might see in the coming weeks and months is that this temporary respite in the trade war could lead to a significant increase again in bookings, especially from China to US. You might have a lot of US importers looking at this and say, this is my window of opportunity. We
Right.
already know, seasonally, we always see a spike leading up to Chinese New Year. Chinese New Year comes late this time. It's in mid-February 26th. So normally you would then seasonally expect this spike to really start to ramp up in early January. There might be quite a lot of importers that are right now sitting in their boardrooms and scratching their heads and say, maybe we should fast forward it, just in case this ceasefire between US and China doesn't stand the test of time. But that has to be balanced against another thing, because in the same boardrooms, they would also be scratching their heads. The US consumer have been enormously resilient during 2025. In spite of everything that's been going on, consumer sales have been holding up nicely. But they are likely also trying to figure out, will this continue? Or will the government shutdown and the impending impact of a lot of the tariffs on Christmas sales, will that finally cause the US consumers to pull back? We don't know. So this is not an easy decision to be made out in the boardrooms right now. You have to weigh the potential upside of fast forwarding some of your bookings now that there is a respite in the trade war versus the risk that the otherwise very resilient US consumer might not be as resilient in the months ahead.
Yeah, that's a really good point to bring up. I mean, if you're having to make those decisions, you're not just looking at like, okay, well, the cost of freight is going down, the duties are going down. Maybe now is our time. You have to weigh that against, are people going to buy the goods or are they just going to
Yes.
sit in our warehouse? And now it's, an inventory holding cost for us. So it's a very relevant point, especially where we're at right now with the US economy. But awesome. Thank you for all the insights there. Any last pieces of wisdom or anything to add there, or should we move on to our last topic?
Yeah, no, I don't think there's anything more to add right now. Again, let's wait and see the actual details when it comes out in the Federal Register or an executive order or something that's actually legally meaningful.
Sounds good. All right. And then our last bit of news here. So we saw a pirate attack recently. That was off the coast of Somalia.
Yes.
Going to talk a little bit more about that?
Yeah, in this case, it was an attack some 300 nautical miles east of Mogadishu, the capital of Somalia. So it's down in the Indian Ocean. It's not up where the Houthis are operating. Nothing came of the attack. There were armed guards on board, and that was successful in repelling the attack. But it should be mentioned that is not the first time we see this. There seems to be a slight increase in recent months and actually over the last year and a half in the region. You have a multinational force that is operating a bit and monitoring the situation. They have also increased their alert warnings for that region. So we shouldn't be blinded that it's only the Houthis causing trouble in the region. There seems to be a bit of an escalation in pirate activity coming out of Somalia as well, unfortunately.
All right, Lars, anything else for this episode, or should we put a bow on it?
I think that's about it. The only thing I want to say is, much as I enjoy being in Ottawa, I'm looking even more forward to later this week where I'm going to join the NYSEX team over in London for their great event together with ICE, and where we get to hear from Sir Richard Dearlove, the former head of the British Intelligence Service, and get a much better handle on all of these geopolitical volatilities that we face in the world going forward. And then afterwards have a chat around what can we do in shipping to try to at least, if not mitigate the impact, then at least find a better way to commercially live with the volatility that we see in the world.
Yeah, it's shaping up to be an awesome event. I heard we have a very big crowd going, so I'm sure you're going to get a lot of awesome insight if you're attending. Lars, you'll have to give me the lowdown since I won't be there. All right, everyone, thanks for tuning in. We'll be back next week. If you haven't already subscribed, we're on Spotify, Apple Music, YouTube. Be sure to subscribe, and we'll see you next week. Bye, everyone.
Thanks for listening to Supply Chain Secrets Podcast, presented by NYSEX. Be sure to subscribe on your favorite podcast app. Want to be a part of the show? Register to attend a live recording at the link below.